Hey, what's going on, guys? This is Blood Phantom 81. Welcome back to my channel. So in this video, I'm going to be talking about the ever so popular and ever so controversial SPHD ETF. We're going to discuss whether or not it's actually a good ETF. I know there's been a lot of criticism, and more than just criticism, but actually maybe some hate on this ETF. So we're going to talk about if that ETF is justified and whether or not I've changed my opinion of it. Because like a lot of earthworms in Northern California, there is a lot of gray area. So we're going to dissect this ETF. Okay, so one of the criticisms I've seen is that SPHD recently took a pretty big hit during this past correction. The market overall corrected about 40%, yet we expected SPHD to not correct as much, which it did not live up to his name. And so the point of it is to basically have the 50 least volatile stocks, while also having very high yield paying stocks. So it did not live up to its name in terms of not being that volatile. So why would we invest our money in something if it's not doing what it's supposed to be doing? And the other thing, of course, is that the recovery was not that significant. So it literally sounds like the worst of both worlds, meaning that it's still volatile, but it doesn't recover as quickly as the rest of the stock market. So this is SPHD basically throughout its entire history, starting in 2014. SPHD from peak to the low dropped about 42%. What kind of low volatility ETF drops 42% while the rest of the stock market also dropped around that same amount? That's absolutely nuts. So I can absolutely understand a lot of the criticism with this one. The recovery has also been less than stellar, where we currently are hovering just below the 0.382 retracement. So basically, we've only retraced about 30% of this entire drop so far. So with the way I'm talking about this ETF, it may seem like I'm biased one way or another. I'm literally just trying to report the facts. Um, if this ETF is your only holding or your majority holding in your portfolio, I don't think that's wise. Not just for what I explained here, but basically, I think there's a lot more upside in other ETFs. But if you strategically, and if we dissect why exactly this is happening, why it hasn't recovered that much, and why it dropped so much, then I think that context alone can put it into perspective of whether or not we should actually own this ETF and what our goals should be when owning this ETF. So, speaking of holdings, surprisingly, the majority holding is actually financials. And unsurprisingly, the next largest holding is consumer non cyclical. So, we can expect a lot of CPG in here. And also, unsurprisingly, the next couple sectors are utilities and energy. So, based on recent stock market history, the energy sector has been demoted to sort of a more defensive and high yielding sector, especially with ExxonMobil and Chevron basically being just high yielding stocks, which you don't really know if you're going to get your money back in terms of capital. Obviously, there's a lot of biased opinions, but it's obvious that the energy sector probably is one of the weakest sectors in the entire S&P 500, and the upside is quite limited with the stocks that are currently in the energy sector. Obviously, this might change in the future if we have a lot of innovation in this area, but a lot of the stocks currently in the energy sector, the upside is pretty capped. Utilities, I think, are pretty interesting. And so, what we're going to talk about next is why people even own utilities and what the heck actually happened during this past market correction. So, utilities, I think, are a pretty slept on sector in the sense that a lot of people don't consider them to be actually quality investments. I wouldn't go ahead and pick out individual stocks and tell you, these are good investments. But I'm just saying, as a whole, utilities actually perform pretty well. And the performance goes both ways in the sense that when the market is acting volatile, and I'm talking about the overall stock market, you can expect utilities to actually perform pretty decently. For example, the entire stock market between October to December of 2018 lost about 14 to 15%, and it was just an overall pretty volatile time. Yet in this time period, it doesn't even seem like there was that big of a drop. So, for example, obviously there's this right here, but you can pretty much expect utilities to go sideways for that time period. Whereas if you look at the S&P 500, for this exact same time period, August to December 2018, it was anything but stable. So obviously there's a pretty big drop. I think this was like about a 15% drop just from October highs to December lows. What we saw here during this past correction, where obviously the stock market lost about 40%, honestly was pretty unprecedented in the sense that none of the sectors that we expected to be defensive were actually being defensive. What this shows is a total sign of capitulation. So like it's not even like people are moving their holdings around or getting into defensive sectors or moving money around. It's literally that during this time period, money just exited quite quickly, and there wasn't really that much of an opportunity to run and hide into any single individual sector, as I've been pointing out. So yeah, anything between REITs to utilities to CPG just got absolutely crushed. Good things tend to happen after complete capitulation. The only times we actually capitulate completely is during really severe bear markets. I'm not talking about, 10% corrections, 15% corrections. I'm talking about, pretty significant bear markets is where we see just total capitulation, where every single sector is killed. A lot of people like to talk about, oh, I invest in Home Depot because they're going to survive in the recession and they're going to perform well in the recession. Well, maybe the company performs well in the recession, but during actual recessions, like people are just heading for the exits, and that's why, new money can come in, and with people on the sidelines, new really strong rallies can emerge. So it's not so much that the companies themselves are performing well or not well during a recession. Obviously, not every single company is going to be recession proof, so to speak, so you have to pay attention for that. It's just that there's a key distinction between capitulation and sort of sideways markets. Because on most occasions, defensive sectors will do okay. Moving on to financials, so they represent about 33% of SPHD, which is a pretty high amount. So if you don't like financial stocks, then this may not be the ETF for you. The reason why I say it's actually kind of surprising is because a lot of these stocks don't really jump out at us at being financial. So obviously, like IRM is a REIT. Gilead Sciences is a healthcare company. PM and Altria are both cigarettes and I don't know what to call them. I guess consumer defensive. And then you have utilities. You have another CPG. You have a telecom. You have a tech. And then I mean, obviously this is a financial company, but yeah. So I mean, in the top 10, this doesn't really jump out as being financial. But in my opinion, that's enough for SPHD to get weighed down. And throughout my videos, I always talk about how correlated all the stock market is. For example, if we compare Apple and Microsoft over the past 10 years, their charts look extremely similar. Despite them being actually competitors, we would expect maybe one to perform better if the other one isn't performing so well. But the truth is, when a lot of investments are made, because everything's so correlated, everything tends to move together. And so this could be a bad thing if it's a sector that's actually growing and has a lot of money going into it, such as semiconductors or technology or cloud technology. But this could be a bad thing for other sectors. And you start to see that disparity of performance be a lot more pronounced, basically. So what we're looking at is the financial sector of the S&P 500, and it is obviously not performing that well. It is worlds apart from something like technology. We probably wouldn't even consider them to be, similar at all. And they're not that similar because a lot of the holdings here in XLF are things like Bank of America, Chase, and Wells Fargo, which unfortunately is not seen as that favorable by the market right now. Could be for any number of reasons. So I have a couple hypotheses for that. So basically, I compared this time period with the 2000 dot-com bubble, and I consider these time periods to be pretty similar. Not that I think we're at peak bubbles yet, because if you actually look at 2000, you can see that the market did amazing things and just like continue to run. Like we're nowhere near peak bubble levels, despite what a lot of people will tell you. I think it was just insane what happened in 2000. But the similar aspect is that a lot of up and coming technologies are being seen as very, very favorable by the stock market, where a lot of old technologies, obviously like bank stocks, aren't seen as that favorable. And the other thing is that technology is starting to become extremely important in every single sector, basically. Maybe minus a couple like REITs and industrials, where it wouldn't really make sense for technology to really take things a lot further. Obviously, that could change, but we're seeing a lot more innovation in things like consumer devices and just consumer-facing products in general right now. But as a result of that, we're starting to see PayPal and Square, for example, which are very clearly financial companies, actually be included in a lot of technology ETFs. Is Tesla even a car company or are they a technology company? Is Domino's Pizza even a food company or are they a technology company? So we're starting to see a pretty obvious shift in just like overall paradigm and what we consider tech and what we consider not tech. But I do think at some point everything is going to get balanced again in the sense that financial companies will become financial sector companies because at that point everything is going to be technology. So just to sort of wrap things up, whenever I see people critique SPHD, it sort of seems like they're critiquing the current market environment more than they're actually critiquing the ETF itself. Not that I care if people critique SPHD, I just think like there is a lot of gray area, as I mentioned. And again, I want to reiterate my point. If it's your majority holding, then you should probably not do that. Because unfortunately, a lot of stock market performance isn't necessarily directly tied to how companies are performing, but more so what they're represented as. In which basket do these companies belong? Because that's how they're going to be seen as favorable or unfavorable by the market. So anyway, that's enough jargon and financial talk. Now the real question is, do I own a SPHD and what kind of strategies would I do if I did own SPHD? So the truth is I still own SPHD and I'm not necessarily selling. I do have about $10,000 in SPHD. I could have had a stop loss on it once it got above my actual average cost, but I didn't do that. Mostly because I was locked in for a really awesome dividend yield. And it's possible that some of the companies in SPHD may cut their dividends or may already cut, but SPHD will actually take measures to remove those underperforming companies. And I was locked in at basically a 6% yield on cost when I purchased this one, which is only increasing because I have my drip set up. So I've already repurchased about 2.6 shares simply through drip. If you guys don't have drip on Robinhood, then make sure you get on their waiting list because I think they're rolling out features obviously based on where you are on the waiting list. So I'm getting close to about a 6% yield on cost, as I mentioned, and I'm selling covered calls on SPHD. So let's go ahead and take a look at my activity. So just in the past week, actually, I've sold about 3 covered calls. So one contract that worth $10, one worth $25, and one worth $10. So it's about $45 in options premium that I'm most likely going to keep, especially because I do anticipate the market to cool off a little bit right here. So wait a second. So I'm getting $45 in option premium, but I'm getting $46 in dividend income. That's exactly what it sounds like. I'm quite possibly doubling my dividend income on SPHD. So I'm getting close to around a 10% yield on cost as long as I keep up this strategy. And it's not even the riskiest for these shares to get called away, especially because SPHD doesn't move that much. So if there is a critique for how little SPHD moves, and I say, well, why don't you use that to your advantage? The premiums may not be that awesome, but it's actually pretty reliable. So that's currently how I'm using SPHD. If the shares get called away, I most likely will not buy them back. But I'm pretty much doing that and just doing that strategy until the wheels fall off, basically. And the last point I want to make before I wrap up this video is why I even purchase SPHD in the first place. And the truth is I actually like a lot of these companies that SPHD owns. I don't like all of them, but I do like at least more than half of them. And I would never actually own them individually. So SPHD is my exposure to these sort of underrepresented sectors in my portfolio. Honestly, maybe like 90% of my portfolio is in extremely volatile tech. So I do like being exposed to REITs and CPG and financials in a different way. Obviously, financials are seen as more of a value kind of play in the current market environment. And so that's another reason why I'm sort of getting back into SPHD. So this strategy doesn't really work for everyone, and I completely understand that. I just wanted to offer a different perspective. Let me know if you guys have any questions or any thoughts or concerns. And yeah, thank you guys for watching, and I'll see you guys in the next video.